Did you know there's more to the fixed and variable rate than just the number? Should you even care? Hi, I'm Nicole Chater-Bressi from Dominion Lending. Stick around, I'll tell you why you should. So you're getting a mortgage, and the first decision that you have to make is, which rate should I choose? Fixed or variable? The one that you do choose will have an impact should you need to break your mortgage. Statistics show that 70% of people break their mortgage within a 5-year term. Why would you break your mortgage? I don't know, things like I'm having a baby and I need to move. I lost my job and I need to refinance. I met someone and I want to move out of province. This is where that initial decision you made will come into play. So before we get into breaking a mortgage and the penalties that you could incur, let's talk about what these rates actually are. A fixed rate is just what it sounds like. It does not change. Interest rates do fluctuate, and whether they go up or down, it won't matter to you because your rate will stay the same. The cost for that interest rate peace of mind is going to be the lender charging you typically a little bit of a higher rate than they would on the variable. A variable rate does fluctuate, which is always great news when interest rates are going down. It's when we come to the penalties that there are differences. The penalty for breaking a variable rate is typically 3 months interest. The penalty for breaking a fixed rate is the higher of the 3 months interest, or the interest rate differential, or the IRD for short. This calculation is made in 2 different ways. The first way will take into account the Bank of Canada rate, right now set at 4.79%. From that, they're going to subtract the discount that you got. And yes, you probably did get a discount. From that number, they'll subtract the time left on your term. Let's say, for our sake of our example, it's going to be 3 years. So they're going to look at what their going 3-year rate is. And then they'll multiply that number by 3 for the 3 years that you have left. That percentage is going to be somewhere in line with 4.5%. And that, my friends, is how much you're going to owe on the balance of your mortgage. This is where you hear about people owing tens of thousands of dollars just to get out of their mortgage. The second way it's calculated is a little more in line with published rates. And that's a rate that you would see on a lender's website. So that published rate minus the rate that you have on your mortgage times, for our example, 3 years, will give you a much lower percentage, and you won't fall off your chair when they don't quote you a number akin to buying a brand new Kia or something. So this is where a mortgage broker is important, because it's their job to read all that fine print that nobody reads. When you're in your banker's office, you're not going to say, hey, let me hang out here for the next half an hour and go through these 20 pages of fine print. No, you see the rate, you like the rate, you sign on the dotted line. And the rate is important. Yes, it is. But the terms are even more so. Life does get in the way, and who knows if you'll have to break your mortgage. But it's best to know what it'll cost you if you have to, before you even get there. This has been Nicole Chater-Bressi. Join me again for more financial tips to help you make better decisions.